come back to you to say as to where we are on the various announcements which were made before the Parliament session commenced, the winter session, and in them what progress has been made, so that we have before us clearly, prior to the budget session, a template which, from the ministry's point of view, addresses questions or has laid down the landscape before us on both the legislative and also post-July budgets, various measures that have been taken. So we thought it's just the right time at the end of the winter session's closure for us to come before you and speak about the various measures taken. In the meanwhile, many tying of the loose ends and also some results which have started showing for the measures that we've taken are also before us. So we would like to take this opportunity to present all that before you. So thank you. I'll first commence it with a comprehensive, not a very big, but a comprehensive presentation by the Chief Economic Advisor, post which, of course, the Revenue Secretary would have something to say. Then the floor can be opened. Thank you.
So I'm going to, as the Honorable Finance Minister has rightly mentioned, I'm going to briefly touch upon the major interventions that have been undertaken to boost the economy. Let me start by recalling that the economic survey that was presented in July outlined a plan for the economy to become a $5 trillion economy, with investment being at the key driver, and anticipated consumption itself driving investment, and an emphasis on significant reforms. The steps that have been taken over the last few months actually can be seen in the light of this planned economic strategy that the government has set about. On the consumption side, and I'll go into some detail on each of these, the government has focused on clearing all the government dues, including those of the public sector units, on enabling retail credit by supporting the NBFCs and the housing finance companies, which are very important for credit that's given for consumption in the economy. There's been emphasis on supporting the MSMEs, via bill discounting, because MSMEs, for them, cash flows are really critical, and therefore enabling them, to sort of have cash flows by providing them avenues for bill discounting, and then tax refunds. So together, all these four are intended to bring more cash flow and thereby foster consumption in the economy. On the investment side, I'm going to describe a set of measures, a package of measures that have been taken to enable capital markets for financing. As you all would certainly appreciate, that financing is absolutely critical for investment. So these steps will go a long way in enabling investment through financing. The government itself has focused on capital expenditures. Again, we all recognize that government capital expenditure has the benefit of crowding in private investment, and therefore government capex is extremely critical. Foreign direct investment, which has actually come in record numbers, that's something which is very critical for investment by the corporates. The corporate tax rate cuts, which were done to enhance the risk-return trade-off that the corporates face when they decide to make the investment. Supporting the completion of the real estate projects by providing them last-mile financing. Recapitalization of the public sector banks, which was announced in the budget and has been followed up. The credit expansion by the public sector banks by emphasizing some of the aspects that were needed to be emphasized, especially enabling honest decision making. The third leg is on various reforms. As has been mentioned already, there is a change in the emphasis on disinvestment to thinking about using disinvestment to enhance efficiency in the economy. The measures that I'll talk about, a lot of them, actually all of them, have used transparent and targeted due diligence to enable that so that investment really goes where it is intended. The ease of doing business, the improvement in the rankings that happened, in the World Bank's rankings, that's reflected in some of the steps that have been taken. And finally, on labor laws, I'll then also end with talking about some important patterns that are emerging in the economy, over the steps that have been taken in the last few years. So let me get on to the measures that have been taken to support consumption, to support NBFCs and the housing finance companies, which in turn, as I said, are critical for retail lending. Total sanctioned support has been of 4.47 lakh crores, which in fact includes 1.29 lakh crores of pooled buyouts as well of assets. The partial guarantee scheme, which was a very important facility for NBFCs for taking care of some of the stress that NBFCs and the HFCs were going through. The cabinet approval has been provided for those borrowers that had slided into SMA 0 category, and for asset pools that are rated BBB plus or better. And this is really important because the emphasis then is on those asset pools that are not able to actually find a market. Thereby, the intervention becomes quite effective. Within 2 days, 17 proposals amounting to more than 7,500 crores. In fact, 7,657 crores have been approved, and proposals amounting to about 20,000 crores are expected to be approved over the next 2 weeks. So there's substantial traction on this partial guarantee scheme for the NBFCs and HFCs, which in turn will also foster consumption, on the retail side. The government and the public sector units have cleared significant dues in 2 stages. Again, this is something that is important because that enables cash flow, movement of cash flow in the economy, and thereby enables consumption to get fostered. Up to 61,000 crores of dues were cleared previously. In the second round, of the 32 CPSEs, which is basically the Navratnas and the Maharatnas, more than 60% of these dues, and I emphasize more than 60% of these dues, have been cleared in the last 2 months. There is also an important mechanism that has been put in place to ensure that, going forward as well, the dues that the CPSEs owe are low, and therefore cash flow in the economy is actually transmitted smoothly. 21 out of the 32 Navratnas and Maharatnas have now set up an online bill tracking system to reduce the pendency in bill payment and reduce the accounts payable in the system of the CPSEs permanently. Now, what is due is actually less than 5,000 crore, to be precise, 4,877 crores. That's what is due. So this is another key measure that has been implemented upon to enable cash flow and thereby consumption in the economy. Following up on some of these measures, the RBI guidelines mandating banks to link their lending rates to external benchmarks. Following that directive, all public sector banks have introduced repo rate linked loan products. And in terms of the traction that we've had in this particular move, more than 8 lakh repo-linked loans amounting to 72,201 crores, so more than 70,000 crores, have been sanctioned as of 27th November 2019. So more than 8 lakh repo-linked loans amounting to more than 70,000 crores till end of November. The MSME bill discounting, which is quite important because, as I had mentioned earlier, the MSMEs, for them cash flow is really critical, and when they're able to actually use their bills to discount and thereby tide over their cash flow problems, that's an important measure in enabling consumption because MSMEs are critical to that. Over 5 lakh bills amounting to 12,698 crores, so over 12,500 crores. Over 5 lakh bills amounting to more than 12,500 crores have been undertaken in this window till 15th November 2019. Also, a transparent one-time settlement policy in the public sector banks was announced, and on that, the implementation over 5.25 lakhs, so over 5.25 lakh, that's 5.26 lakh of loans that in numbers and in the amount 16,716 crores. So over 16,500 crores has been sanctioned. So collectively, when you look at all these measures, these are expected to boost consumption significantly, and thereby also actually, because anticipated consumption affects investment and would have a positive effect on that as well. Now, let me come to the specific measures that have been taken to boost investment. This is something that, the liberalization of the FDI, many measures were announced in the budget and subsequent to the budget as well. Many measures were announced, and the evidence of those measures fructifying is actually seen in the record FDI inflows. $35 billion in the first half of 2019-20, as against $31 billion in during the same period last year. So $35 billion. So this is a very good sign of actually foreigners seeing India as a very, very important destination, and thereby actually putting their money where their mouth is. The corporate tax rate cut, 15% tax rate cuts, now makes us competitive, as competitive as any other country among our peers. Importantly, given the large market that we have and the large labor force that we also have, compared to these peers, the competitive tax rates also position us more favorably, because as you would realize, the foreign companies that come in usually have to incur some fixed costs in coming into a new country. When that can be spread over a large base, it gives them significant advantage. So that positions us very well for bringing in more foreign investment as well. Capital expenditure by the government, as I had preambled at the outset, capital expenditure by the government has the benefit of crowding in private investment, and of course that happens with a lag, but that is something which is very crucial. 66% of the budgeted capital expenditure of 3.38 lakh crores has already been undertaken. So, more than 2/3 of the budgeted expenditure of 3.38 lakh crores has already been undertaken. The Indian Railways and the Ministry of Road Transport and Highways, they projected to undertake capex of about 2.5 lakh crores by the end of this month. Of course, they'll be also undertaking capex in the remaining 3 months as well. This is the number for as of 31st December 2019. The select CPSEs that I had referred to, 32 of the Maharatnas and the Navaratnas, have undertaken capital expenditures of close to 1 lakh crore, precisely 98,000 crores till November 2019, and are projected to undertake further capex of about 60,000 crores in the rest of the year. So together touching about 1.6 lakh crores. So that's the extent of capital expenditures by the government and the PSUs, which would help to boost investment. The realty fund, which is very important given the some of the difficulties that the real estate sector was facing, the fund of about 25,000 crores to be precise has been approved for last mile funding for the stalled housing projects. It is very important to keep in mind here that the actual impact of this fund will be many, many times this, because, on average, the construction cost is about 1/5 of the cost of a project. And if we suppose that on average these projects are half done, then at least 10 times the impact of this last mile funding will be in releasing projects. So about 2.5 lakh crore, just some back of the envelope calculations. Now, this fund, which is basically, has the name Swami, is fully operational, and the investment committee is completing the due diligence on the first set of deals today as we talk. The necessary changes that were required to enable this have been done in the bankruptcy code. Now, what is very important, I must emphasize, actually, I brought this to your attention when I spoke about reforms, is that this has been done through careful due diligence, which requires, as you would appreciate, coordination across several different arms of the government, but that has been done in record time. 6 to 8 weeks as against usually what would take 6 to 8 months, and that is something that is quite heartening. The fund has found excellent traction from 13 domestic financial institutions, including HDFC, SBI, and LIC. legal documentation for more than 10,500 crores has already been executed, which is again evidence of actually traction on the scheme. What is important is that this process of due diligence has incorporated some of the lessons that we've gathered from previous episodes of fiscal expansion, so that the investment that is intended here is targeted and transparent, so that it generates the intended bang for the buck. The credit expansion via the public sector banks, budget announced 70,000 crores of equity, 60,000 crores to be precise, 60,314 crores has been infused already, and 4.9 lakh crores has been disbursed. Of that, 2.2 lakh crores to corporates, about 73,000 crores to MSMEs, and 39,453 crores to retail borrowers. This is basically in the window that was done in October. To enable, and protect honest decision-making among the public sector banks, an internal advisory committee has honest decision-making among the public sector banks. An internal advisory committee has been, set up, which is basically to classify cases as vigilance or no vigilance. And what is critical is that this internal advisory committee, together with the chief vigilance officer, would basically make the final decision in classifying cases into those that basically may, require a vigilance look or no vigilance. And an advisory board has also been set up for looking into bank frauds. So together, these will enable actually better decision making, while at the same time ensuring that instances of frauds, etc., are actually clamped down. Importantly, if we have to, have more investment, financing is really critical, and for which capital markets are really important. Sorry. So the law that was passed by Parliament for setting up a unified regulator for international financial services, I think, is a very, very important move that we need to take cognizance of, because this will enable capital flows by reducing regulatory and compliance burden, because now these regulatory and compliance activities can basically be done in a one-stop shop, and thereby would bring back trading of Indian financial products from offshore centers onto onshores. The regulatory burden for equity and equity-like instruments like preferred shares, etc., have been eased through comprehensive rules for non-debt instruments under FEMA, and this will also enable to streamline foreign investment. This is an important move, the one unified market across the country for financial instruments through the rationalization of stamp duty. It was a key recommendation in the HR Khan committee to foster development of the corporate bond market. So this one unified market by rationalizing stamp duties is a significant move in expanding the presence of corporate bond markets. A revised ECB framework has been prescribed to rationalize the scheme for accessing foreign debt for Indian companies. And crucially, this includes working capital loans and rupee-denominated loans by Indian corporates, which will enable capital raising by the Indian corporates for funding investment. Some more measures on capital markets. A framework for debt ETF has been notified by the SEBI, and the Bharat Bond ETF that has made news utilizes this framework. A framework to allow shares for differential voting rights, which is a very important move for startups, because startups need to avail funding without basically, losing control over the company. So the allowing of differential voting rights, shares with differential voting rights, really enables funding for startups, and thereby is an important move for the new economy. Interoperability among the clearing corporations has been implemented, thereby will enable efficient use of capital for clients that trade on multiple stock exchanges. Plain vanilla options in commodities have been enabled, and this will enable hedging of the risks, especially on agricultural commodities. And norms for that are applicable to credit rating agencies have been tightened. As you would appreciate, credit rating agencies are a critical cog in the corporate loan market, and this will really enable further development of the credit markets, because investors look up to the credit rating agencies for information on the credit risk of the borrower. in terms of enabling foreign portfolio investment, the KYC norms have been simplified. In consultation with the ministry, SEBI has approved several changes in the norms as of 5th November 2019, and this includes simplified documentation and exemptions for regulated entities. The statutory limit for FPI investment in a company has been increased from 24% to the sectoral foreign investment limit, and this will be effective from the 1st of April 2020. On 4th October 2019, RBI announced its decision to permit USD INR trading at the GIFT IFSC, and this is very important because it will enable actually foreign exchange markets to develop further, because domestic banks can now freely offer foreign exchange prices to non-residents at all times, and will also bring in offshore rupee market to the domestic stock exchanges, and thereby permit trading of USD INR derivatives in the GIFT IFSC. Some important reforms, as I said, on disinvestment. The emphasis has changed on disinvestment to enhance economic efficiency, and therefore disinvestment in non-priority areas where competitive markets have already taken root, have come of age. Those basic have been undertaken. These include BPCL, Concor, and Shipping Corporation of India. Will enable private buyers to bring capital, importantly technology, and also better management, thereby enhancing productivity in firms, which will basically accumulate into growth at the economy level. The bandwidth for disinvestment has been, especially through minority stake sale, has been widened by bringing down the government's equity to below 51%. It's an important move because it actually releases significant bandwidth, and that's been done on a case-to-case basis, which will increase wider, which will lead to wider public ownership of the shares of the selected CPSEs. The Bharat Bond ETF, which you would have read about last week, has also enabled participation and wider pool of financing for the CPSEs. Some measures on the ease of doing business, as you would have, noticed and recalled. India jumped to 63rd in the World Bank's EODB rankings, and the bankruptcy code was a primary contributor to this. There have been important changes that have been brought in the, in the bankruptcy code as well, ring fencing successful bidders of stressed assets from the risk of criminal proceedings, when offenses have been committed by previous management and promoters. It's an important aspect in order to enable the functioning of the IBC. And importantly, the threshold for financial creditors has been imposed to ensure that there is no frivolous, triggering of insolvency for very small amounts. Thereby, the spirit of the bankruptcy code is actually indeed respected through these changes. There is no need now for a debenture resumption reserve for debentures that are issued by listed companies, by banks, NBFCs, and housing finance companies. This will reduce the cost of issuance and thereby help in fostering the development of the corporate bond markets. Crucially, CSR violations have been decriminalized and are to be treated as a civil offense. NBFCs have been permitted to use the Aadhaar authenticated bank KYC. So all these together are important steps in easing doing business in India for corporates, and thereby should also have impact on investment by corporates. Crucial part, which actually investors have been clamoring for and have been mentioning, is the reform in labor laws. The about 40-odd labor laws that existed at the central level have been now codified into 4 codes: the Code on Wages, Code on Occupational Safety, the Industrial Relations Code, and the Social Security Code. The Code on Wages, as you would know, actually has been notified in August 2019. The Code on Occupational Safety, Health and Working Conditions, was introduced in Parliament in July 2019. This brings together 13 central labor laws, within this new code. The Industrial Relations Code has been introduced in Parliament on 28th November. It amalgamates and rationalizes 3 central labor acts to impart flexibility to the exit provisions, especially by enabling fixed-term employment contracts and also enabling thresholds to be notified, thereby providing flexibility for attracting investment. The Social Security Code Bill was introduced in Parliament on 11 December, and this will enable universal security for workers. To enable the take-home that employees get to take to their home, the contribution of ESIC has been reduced from 6.5% to 4%. This will thereby put more money in the hands of employees, and thereby should also help in fostering consumption. In terms of compliance to labor laws, the web-based jurisdiction-free inspections have been enabled with report to be uploaded within 48 hours. Thereby, the compliance requirement will actually be simplified significantly in the employer-employment relationship. Now, let me just conclude by highlighting some important trends that are emerging in the economy, which we should certainly take note of. So this is some analysis that we've done on the status of employment, comparing it in 17-18 versus 2011-12. As you would recall, there have been several measures that have been taken over the last 5 years to formalize the economy. What you notice here, and this is the most important aspect to take note of, is that if you look at the distribution of employees between casual workers, regular salaried workers, and self-employed workers, what you would notice is that the percentage of casual workers has gone down by 5%, and the regular salaried workers has gone up by an equivalent 5%. So in 2011-12, the percentage of casual workers was 30%, which has come down now, and regular salaried has gone up by 5%. This translates into about 2.3 crore jobs moving from casual workers to regular salaried. Within the self-employed as well, and that's some important variation that one must actually focus on, which is that within self-employed, the self-employed could be an employer, could be an own account worker, which is somebody, a mom and pop store, for instance, or unpaid family labor, which is actually the kid or, let's say, the wife working without getting paid. Within this, the important change that has happened is that unpaid family labor has gone down and own account worker has increased. And if these changes, especially on the movement from casual workers to regular salaried, is seen a lot more in the rural areas, with casual workers basically moving to salaried. In the urban areas, the move is from self-employed to salaried. So this is an important, transformation that is happening in the economy, formalization of the workforce. If you look at it from a different angle, the proportion of workers in agriculture has gone down by 5%, and this has been absorbed by a 4% increase in services and a 1% increase in industry. And this change is particularly highlighted in the rural areas where people have moved from agriculture to services. Finally, if you look at the organized versus unorganized distribution, organized workforce in the organized sector has increased by 2%, with a concomitant decrease in the unorganized sector by 2%. Within the organized sector itself, if you focus on the split between informal versus formal, there's a decrease in the informal sector and an increase in the formal sector. So when you look at it collectively, all these different angles that I've provided, this clearly suggests that there is actually a change in the nature of work. And that's one other way of looking at it is by splitting this into remunerative versus less remunerative jobs. And the proportion, I want you to take a note here, is that in the rural areas, proportion of remunerative jobs have increased by 3.3%. So the less remunerative ones have actually decreased concomitantly. In urban areas, the increase has been about 1.4%. In aggregate, there is actually an increase about 3.2% in the remunerative jobs and a concomitant decrease in the less remunerative, which is consistent with what we saw with salaried workers increasing, with agriculture going down, the proportion of services and manufacturing increasing, and organized actually increasing within organized itself, formal versus informal. So to sort of conclude, there are important steps that have been taken, and which is also reflected in the change changing nature of the economy over the last 5 years. Thank you.